With the tax season just around the corner and property investors constantly navigating a shifting taxation landscape, it's never been more important to stay one step ahead of the taxman. So whether you're a seasoned investor with a big property portfolio or just starting out with your first rental, the rules are changing, and some of these changes are flying under the radar. So in today's episode of the Michael Yardney Podcast, I'm joined by my business partner, Ken Race, Director of Metropole Wealth Advisory and one of Australia's leading property tax strategists. Now, Ken's got his finger on the pulse of what's really happening behind the scenes with the ATO, and he's going to share with us some recent tax changes that could hit your hip pocket. We're going to unpack some new rules around foreign buyers, around audits and compliance activity, and what the ATO is targeting in property investor returns, and why even honest investors could be at risk of making some costly mistakes. Also, Ken is going to explain what to do proactively to protect yourself, keep more money in your pockets, and stay compliant in a far more aggressive tax environment. So if you want to know what's changed, what it means for the bottom line, and how to make smarter, safer moves moving forward, stick around. This episode could save you thousands.
Welcome to the Michael Yardney Podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Ken, it's always great to have you on the podcast. And I have to say, after going through the notes that you provided me for this show, I'm glad you're in my corner with the tax. There's lots happening in the tax space this year, isn't there?
There certainly is. And the ATO in particular is getting a lot more aggressive with looking at tax returns. And they're using AI and IT systems. So they've gone effectively from a payroll number of, however many tens of thousands are in the ATO to unlimited, given access to all this IT.
Isn't that fascinating? I hadn't thought about that. So if ChatGPT can find things that I can't, I guess they're going to use not ChatGPT, but other very clever computer power. I've actually heard they've got a huge budget for this, Ken.
Yeah, last year's federal budget put aside $1 billion, $1 billion for their IT system. And if you think they've had similar numbers or close to over the last handful of years, they're almost the largest IT department in Australia, if you take the Amazons and the Microsofts out.
And this is, I guess, on the basis that they believe they're going to be able to actually collect significantly more than $1 billion worth of tax, otherwise they wouldn't do it. So maybe we could just have a chat about how, in this chat today, about what property investors should watch out for, what the tax department's looking for, and how we can protect ourselves. So let's start at the top with the big picture. What are their new powers and reviews tactics, in particular with property investors? What are they looking for there?
So I think there's two things, and we can split it into two sides of a coin: meeting the legislation and following what they say is the correct interpretation of that. So they're actually seeing a lot of people attempting to do the right thing, but making mistakes, not dotting the I's, not crossing the T's, trying to do their own tax returns and not fully understanding, maybe not having a property-specific accountant to help them with their property investing administration. Because property is becoming more and more a very unique asset class with its own rules, particularly under tax. So having just the normal mum and dad accountant is probably now no longer sufficient.
Well, I thought that both parties are actually saying we're going to be paying less tax. That's the election discussions, isn't it? But the ATO is using this IT, the enhanced data matching service, and you and I had a chance to have a chat with the Assistant Commissioner of Taxation on this podcast. So if anyone's listening to this or watching this and hasn't seen where Ken and I interviewed the Assistant Commissioner of Taxation earlier this year. Go back into whichever podcast app you're watching this or listening to this on and have a listen. So you as an accountant, even though you don't do the accounting numbers anymore, I know keep track of it. And we've even, as we've just said, got access to the tax department. In some ways, they like to get their message across to us. What are they doing? How far reaching is it? What kind of activity for property investors are they looking at?
So I think the first thing is the expenditure in the IT area has allowed them to enhance their data matching. So we all remember years ago when doing our own individual tax returns, the ATO was talking to the banks, so pre-inputted your interest figures in your tax return. We stopped doing the employee certificates on how much tax we've paid. That now gets pre-populated. So they've expanded that now to talk to many more departments, regulators, and service providers to the property industry. So they now talk to the state government. Who would have ever thought the federal government would talk to the state government? But they talk to the state government to see transfers. And that's not only that you've bought something, but have you sold something? They're talking to insurance companies to see what is being insured. They're talking to the local councils. So they're actually now, their fingers are in many, many pies that actually interact with property investors, because we all talk to the insurance companies or the bank or whoever. Now the ATO's got direct input into all that. So that data matching means two things. You can't omit or lie, but what it does, and this is the biggest thing because most people try and do the right thing, is it helps identify and increase sample sizes of the number of taxpayers they will talk to. And what they're finding is a lot of taxpayers are making, and these are my words, inadvertent mistakes. And they've sort of got a hit list, if I can call it that, of those most missed opportunities that the ATO hasn't collected tax. So while they haven't increased the tax rates, they've actually made it, if you like, more efficient for them to find you if you haven't done the right thing.
And it's not just the mechanisms that you mentioned a moment ago. I know they're looking at Airbnb and stays and property managers to see what rents are collected, bond services as well, where tenants put their bond in. So they know exactly what properties are rented, who owns them, what rents are being collected. So you can't avoid that anymore. What are some of the more significant tax changes property investors need to be aware of now? How are they impacted by some of these things?
I think that physical changes they've made are quite minor in the scheme of things. Obviously, fixtures and fittings depreciations was lost a number of years ago. The ability to travel to inspect your properties, they got rid of that a number of years ago. They've, if you like, eliminated the capital gains tax discount for non-tax residents. So even if you are a Australian citizen, you move overseas, you use your house now as an investment property, you will now pro rata lose the 50% capital gains tax discount because you're not an Australian tax resident. The big one they've recently made is the loss of the main residence exemption. That being, if you sell a home, you don't pay tax on it. If you are overseas again, you're an expat, you get transferred overseas. While overseas you sell your home, you lose that whole main residence exemption. There was a bit of grandfathering back in 2019, but it's no longer available. So you get the 50% discount, but if you had your home for, call it 20 years, you go overseas and you sell it within the first year, you don't get 19/20ths tax exempt. The whole amount is a loss of the main residence exemption.
That doesn't seem fair, does it?
A trick for young players there.
Yes. They've also been more careful with certificates in case you're selling your property to foreigners. And I know you've got to get a clearance certificate now, otherwise you get tax withheld.
That's right. So if you sell your property, you need to get a tax clearance certificate, or else the purchaser withholds 15% of what they would have paid you, and you've then got to wait till you do a tax return. And that applies whether you're selling $1 million property or a $20,000 property. So there's now no minimum where there used to be before. Properties over a certain amount used to be captured. It's now all the properties. So that's a task that you would now give your conveyancer to do if you're selling, and most conveyancers do that as part of the conveyancing work.
Now, we're talking about the tax department, but since we're talking about taxes, the state governments have also, I guess, burdened property investors. There's been a lot of media about that, but maybe it's worth just having a quick chat because different states have different tax laws, land tax changes, stamp duty changes, challenges for property investors that aren't resident. Everyone seems to be coming at us.
Correct. And I heard a frightening statistic a number of years ago where 40% of the costs of a new build was taxes and charges by governments or government authorities. 40% scared the bejeebies out of me, but in this recent discussions about home ownership, first home buyers, there's been a new studies done where that figure is now up to 50%. So if you pay, I'm just going to call it $1 million for a new property, 500,000 of that is government taxes and charges. So there's a big thing.
And while everyone's saying we should be making houses more affordable, once the government starts taking money from us, I have never seen them actually reducing it and giving it back to people.
That's right. And certainly when GST came in, that was supposed to substitute for land tax and stamp duty, and all the state governments agreed, but didn't implement those things. So at the state government level, there's stamp duty, obviously, when you buy a property, and that sometimes is reduced for first home buyers, depending on the value of the property. And each state has got completely different rules of who and how that is applied. So check the various state government websites.
Interestingly, of course, that is something that's often forgotten in conversations about property investors getting benefits from negative gearing and capital gains tax exemptions, how much property investors put into the coffers of state governments with land tax, with local councils with rates and taxes, with federal governments with even if it is at a subsidised cost, capital gains tax, because in general, if people move house and people move house frequently as their life changes, there's no capital gains tax there. So no one seems to complain that homeowners don't get capital gains tax charged.
And people say, why should you get negative gearing? Negative gearing is when your rental income doesn't cover all your expenses. So anyone who owns an investment property has to manage that as a business. And in every other business, if you've got losses, you can claim it against other income. So property isn't isolated in giving you that benefit. And the reason the ATO gives you the benefit of the negative gearing is because they know one day it'll become profitable. One day you'll sell and there'll be a capital gains tax. And I've just remembered a case, I can't remember the name of it, that I read probably a decade ago, where the taxpayer was interviewed and he admitted to the ATO that he never expected to make positive rent.
Yeah.
And the ATO denied him all his negative gearing benefits.
Really? Silly man.
Because he wasn't anticipating making a profit. So if you don't anticipate making a profit, I won't give you the deduction now. So that's the other thing on top of what you've said, that property owners, particularly investors, pay all those taxes that, can I say, most other investors of different asset classes don't pay?
Yeah.
Stamp duty, tax, et cetera. If you buy collectibles, if you buy shares, if you buy gold, there's not those charges. Property investors have been, if you like, particularly picked out as low-hanging fruit for a lot of governments.
Now, before we go any further, I really should mention that this is, of course, specific tax advice for anybody listening to this or watching this. This is really just general information, and you should go to your accountant to understand how these affect you personally. But having said that, Ken, what are some of the mistakes that you're seeing property investors make on their tax returns that they should avoid now that the tax, well, they're probably not making them on purpose, but so that they don't get into trouble with the taxman?
Yeah. So there's obviously a big list that the ATO prepares every year. So while at Metropole Wealth Advisory, we actually don't prepare tax returns for people, a lot of clients come to us to review their tax returns, to get a second opinion, so to speak. And it's from there that we see a lot of common mistakes coming through. So some of the more common mistakes are the overstatement of deductions. People include personal expenses in there as opposed to just investments. So, typical one is you buy a new TV for your home and take the old TV to the investment property or another piece of furniture and then claim the cost of the new piece of equipment. So because its primary source was to be in personal use, then that's not tax deductible. So we see a lot of that sort of stuff going on. The other big area is people mistake, if you like, repairs and maintenance with a capital expenditure. So a capital expenditure is a new item that replaces an old and is then going to last you a long period of time. So let's call it a kitchen makeover. So a kitchen makeover is a capital item and it should be depreciated over 40 years, 2.5% depreciation per year, whereas a lot of people will try and expense it. Or they might just replace a whole row of cupboards and say that's an expense, but that should be capitalized. So obviously, if you've got one cupboard that's been distorted or has fire damage or whatever, you can replace that because you're only replacing part of the whole. So be very, very careful on that. And that is high up on the ATO's hit list. And what they do is, if you imagine every line item on a tax return is identified and the ATO can have a look for that line item. What is the average expenditure that people make? And they can then see whether you're claiming more or less than the average person. And if you're using a tax agent, they go to the tax agent and say, your clients are in the highest percentile of people claiming these types of expenses, motor vehicle expenses. So be very careful there.
If I could just interrupt your train of thought for a sec, Ken, I think this is a really interesting point. So what you have just pointed out is that the tax agent, your accountant, when we've asked people before who's his client, who's the tax agent's client, a lot of them say, oh, me, I pay his bill. But we say, no, actually, you don't realize how beholden they are to the tax department, where they actually look and have a look to see, hey, you've got a whole lot of property investors as clients, but in general, they're claiming more for their house, their depreciation, other things. And so the tax agent doesn't really want to be in trouble or on the hit list for the tax department. So we're not saying that they're not interested in your interests, but sometimes it's worth getting another just thought or opinion, because there's I know a lot of clients who don't even use their structures or trusts correctly. So let's just do a quick shameless plug for what you and your team at Metropole Wealth Advisory do before we spend a bit more time giving good hints and information to our viewers and listeners. What do you do, and why should somebody even come and ask you when they've already got an accountant?
Well, we sort of look at ourselves as the specialist in the field and the accountant as the GP.
Mm-hmm.
So we work hand in glove, if you like, with you and your accountant to identify solutions, better ways of doing things, or in a lot of instances, we have access to strategies that the normal accountant wouldn't have because we are so integrated in this field. And we work so closely with a lot of tax lawyers that we're continually asking not what is the next bright, shiny thing, because that sort of stuff gets you in trouble with the ATO, but what is allowable almost in a black and white sense. And funnily enough, a lot of those things aren't known by the typical accountant. So
maybe I could explain why, Ken, because we know that the average property investor only owns one or two properties. 92% never get past two. So if you've got three or more properties, and a lot of our clients have got six or more properties, they need the sort of information that only 1%, 2% of investors need to take them to the next level or keep them at the level they're at. The average accountant, and in fact, the average investor doesn't need that help either. So even if you're not at that level yet, but that's where you're getting to, I'm going to be leaving a link in the show notes. Just go to metropole.com.au and find out about our wealth advisory services. So what sort of people do you help, Ken? Who should be approaching you?
Well, professionals who are getting into the area of property investing for the first time, property investors, how to buy even that first property in the correct structure.
That's important.
If you are a multiple property owner, then what else can you do to improve your tax position? And it's not only a tax position you should be looking at, it's all the other things that surround property ownership. You've got tenants, things go wrong, they can sue. If an insurance company doesn't pay up or contributes part of the reason for the liability back to you as the owner, you've got a lot of assets that you can lose, including your family home. So how do you protect those assets? And we help a lot of clients put in place strategies to improve that asset protection, which improves how you hand it down to the next generation. So intergenerational wealth transfer is part of it. So we help a lot of clients understand how to hold their properties or other investments now, but more importantly, how to effectively pass it on safely to the next generation. So,
Well, I guess what we're learning is that Metropole's much more than just a buyer's agent. We help our clients safely grow their wealth, protect it, and pass it on to future generations. So I'll leave a link in the show notes where you can just remember, go to metropole.com.au. Now, Ken, a lot of our clients get advice in fact, anyone who works now with Metropole gets advice from part of your team regarding ownership structures. And again, this is not advice, but we know that many more experienced investors own properties in trust structures. They're very popular, not just among sophisticated investors, but people who want to become sophisticated investors. But they seem to be under more scrutiny at the moment. What changes or risks should investors with trusts that hold their assets be mindful of?
I think the ATO has seen the administrative errors that are made in putting together a tax return using trusts as opposed to the legislative requirements. And I sort of have the story, you buy a box of Lego, it's got the nice space station at the front. When you open the box, it's all in minor pieces. And that's like a trust. When you buy a trust, that's only the very beginning. You've got to set it up correctly. You've got to do your minutes correctly. So there's lots of areas that a lot of accountants don't dot the I's and cross the T's correctly. And such then on an audit, the ATO would pull it apart and say, well, it hasn't been done correctly, and therefore try and deny you tax deductions. And it can go back a number of years. So if the ATO found something wrong this year, they're not going to stop it this year. They're going to say, let's look at the year before and the year before.
Now, I know there's some people out there saying, don't get a trust, don't complicate things, it costs extra money every year. And the only reason your accountant is suggesting that is because they want to make more money. I don't agree with that. And I don't own any assets in my own name, and I own them in various structures and a combination of different ones. And I know all our sophisticated clients do as well. But what would you say to that argument that some people are proposing on other podcasts? Just keep it simple.
Look, keep it simple when you're spending $1 million on something just doesn't correlate with me. But when people come to see us, two, maybe not quite three, but two or three people, we say buy in individual names. But then it's, do I buy jointly with my spouse? Do I buy singly? Do I buy tenants in common? Do I buy jointly? Because that makes a big difference as well.
Yes.
So for the other 40 to 60% where a trust is appropriate, we've got to understand the reasons why. And the areas that we look at is asset protection, estate planning, land tax, flexibility, your ability to get around things. And then that determines whether you need a trust or not. So I have had the occasion a number of times where we've recommended a trust and clients saw the benefits, but with all this noise that they hear from outside, they didn't do it. And funnily enough, a number of years later, when they're buying their second or third property, they come to us and say, I remember that conversation, can I do anything about the previous purchase? And we say, no, but let's move forward, because using a trust is the same as saying, I'm going to have a car. What do you need the car for? Is it to move furniture? Is it to move a family? Is it, because you're having a midlife crisis like I had once, so you want a convertible? So you've got to get the right trust for the purpose that you want and then set it up correctly. And more importantly, the annual compliance has to be done correctly.
Now, Well, you mentioned a moment ago that some people buy in their own names, and I know more people are getting into property with family members. Sometimes it's their spouse, and that may sound easy, but maybe it shouldn't be 50-50. And what about if it's other family members, siblings, cousins, aunties, whatever? What are the challenges with those?
The challenges are people don't agree all the time. And one day there'll be a bit of a disagreement, and then you need to split. And imagine one person, and I had this not that long ago. Actually, it was quite a number of years ago. Two sisters that had bought a property together, and one of them was now going to get married and needed access to the money, as you do. And she wanted to sell her half, but you can't sell half a property. You have to sell the whole property. And then the sister who wanted to keep it ends up paying capital gains tax on something they didn't want to sell. And if they want to buy it off the sister that was getting married, you then have to pay stamp duty, of course, on that. The other thing is, depending on which state you're buying, you only get one land tax threshold. So one state in particular gives you allows you to have a land tax threshold each, but the majority of states do not. So you actually use up a whole land tax threshold between two people. Financing is a big issue. So
Yes, it is.
if one person isn't quite up there in the bank's favor, the second person might have to go secondary guarantor. But in any case, when you take a loan out jointly, you're joint and several responsibility. So therefore, each person is responsible for 100% of the loan. So while you may own half a property, you're actually have liability for 100% of the loan. So that reduces your borrowing capacity if you want to do something by yourself, because they'll say, well, on $1 million property, you only own half, that's 500,000, but you are liable for the whole $1 million loan. So lots of issues there. And trust can
Interestingly,
help
there's
there.
a client of ours, a joint client, who has got a commercial property, industrial property with his brother that was inherited from the father. And now there's huge challenges splitting it. One wants to leave, one doesn't want to leave, one wants to sell, one doesn't. I know you know who we're talking about, Ken. And the simple answer is, just be careful in your estate planning as well and how to set things up, because it's funny how when money gets involved, all of a sudden emotions change a lot too. Ken, when we spoke with Rob Thompson, the Assistant Commissioner of Taxation, in the podcast I mentioned earlier, one of the important factors that came up was the importance of having good records and paperwork. What would you recommend to people there to minimise their challenges if the taxman looks at them?
Look, for me, I'll use the word must. Obviously, that's not definitive, but you must use a strategic property manager, someone who understands how to look after your property, because it's one thing buying the property, it's another thing managing it and making sure you maximize its value over time. So the benefit of using a strategic property manager is they understand the rules. But more importantly, they will give you that monthly statement and one at the end of the year. And I tell my agent to pay every expense.
Yes, I
That
agree.
means on my annual statement, there's every expense. And then I only have to give my accountant two other pieces of information, and that's my banking, so interest, because the property manager doesn't pay my interest, and access to my depreciation schedule. And they add those two pieces of info to the statement from the property manager. So it becomes a fairly easy tax return to do. And then if there is an issue with the tenant, at least you've got somebody who understands, who can go to the tribunal, who can actually sort through the tenants, prospective tenants, to get the right one, who can manage, if you like, the property. And the state governments are introducing more and more legislation which is heavily weighted to the tenant.
Yes.
And you've got to be very careful there, because while some of the headline results there show that it's leaning towards the tenant, they've got to know that's not necessarily the case. I'll give you one example. The pets, where you can't just say you can't have a pet. But there are a number of reasons you can say no to a pet. Can they actually damage the property more than the bond? Is there insufficient space? Now, you can't have a Great Dane in a one-bedroom apartment that doesn't have a balcony. So while the headline is you can't say no to pets, there are a number of reasons why you can decline that. So you need somebody who's abreast with all that legislation, who will then make the administration easier by doing the paperwork.
Ken, a short while ago in our chat, I asked you about some of the mistakes investors make and how to stay on the right side of the tax man. And as usual, I interrupted you and I changed your train of thought. But maybe we could go back to some of the mistakes investors make, especially with expenses, because we know that's what the tax man's looking for.
So one of the big ones I see is on interest deductibility. So an individual, normally the higher taxpayer, goes on title to buy an investment property, but the loan is in both names. You might have had to give the property as security, or the spouse's income might have had to be taken into account to meet the serviceability. So you've got a property in one person's name and the loan in two people's names. So the ATO says, well, that's fine. You're only entitled as the investor, the person on title, to half the interest deduction because you're only on the loan for half. So that is, can I say, easily fixed with some additional paperwork. But that costs tens of thousands of dollars if you've done it wrong.
Yes.
Another big one is where people don't have split loans and they maybe get a line of credit to do up their home, maybe put a new kitchen, and it's also being used partly for the investment property. And then they want to pay down that personal loan. Well, you can't pay down the personal component of a loan that's one loan. So when you pay it down, the investment property's loan is reduced as well. So if you're ever going to get additional cash to pay down some personal debt, go to the bank and get a split loan. Get them to split it there and then pay it down.
Again, this is important. I'd actually like to correct you. Rather than go to the bank, I'd be going to a strategic mortgage broker because most bank managers don't understand that as well. And I think this isn't the time to discuss it. Understand how using an offset account rather than paying down the loan may give you flexibility in the future as well. I guess that's a whole topic for another discussion, Ken.
Yep. I like this one, and I see it a bit. Two spouses have bought the property, but the higher income earner, the higher taxpayer, then claims 100% of the income and 100% of the expenses. So giving that tax benefit to the higher taxpayer. So that happens a lot. So you should do 50-50 if you're there together. You should also then talk to the strategic broker will a 99-1 loan work? So can you still get the loan with the lower income spouse just being on the title for 1%?
So what you're actually saying is that's a mistake that people do. Understandably, there's a lot of families where one person earns more for a couple of years, somebody's out of the workforce. So definitely that's something to look for. And you can't change it over time either. So you've got to set it up right.
Because that's a CGT and a stamp duty.
I beg your pardon?
That's to change it is a CGT, capital gains tax, and stamp duty trigger. Yeah.
So again, it's useful, more than useful, it's imperative to get ownership structuring advice before you even buy a property. And again, a shameless plug, that's what we do at Metropole. Everybody sees one of your team members as we're building the strategic plan to discuss what the ownership structures are. And the problem is you've got to be flexible. You used that word a couple of times because what may suit you at this stage of life may not be appropriate in the future. Interestingly, only the last couple of days I read from the AHRIU, a government institution, that younger investors sell up their properties, more than 50% sell up within 2 years. That's interesting how younger people, as opposed to older people, just either get it wrong or don't do it right or choose the wrong property. I think buying a property is a big cost, as you said a moment ago. And in property investment is a process, not an event. So people go off and buy something and think, oh, I've got it right. No, set yourself up right. Otherwise, you'll be amongst those statistics, won't you, Ken?
You certainly will. And the one comment I make, particularly to new investors, is each property you buy sets you up to buy the next one if it's done correctly.
Yes.
And therefore, when you buy this one, you've really got to be thinking, does that help me buy the next one? So you need your capital growth, those sorts of things. You need to have it in the right structure.
Sure. So what other misallocation of expenses have you come across recently?
It's the negative of that, but we see a lot of people not declaring income.
Yeah.
So they claim the expense but don't claim the income. And, the ATO now is well and truly on top of that, notwithstanding we see a lot of people do that. But in a broader sense, Australian taxpayers are taxed on their worldwide income, irrespective of its source. So we see a lot of people who have got assets overseas they might have been an expat, or they might have bought it when they were living there before they migrated to Australia, and they don't declare that income. So you've got to self-declare in Australia, and you've got to put all your income irrespective of its source. So put that in there. And in some instances, you might, if you've had to pay tax overseas, you'll get the benefit of that tax credit in Australia.
Ken, I guess in conclusion, this discussion has shown that tax compliance is a complex area of the tax law, and in particular for property investors. Now, I know you also deal with business owners and help them structure their businesses, because often the money's involved is even bigger than property investment. And sure, maintaining records is valuable, but I really think people should get professional advice from a tax specialist. It goes a long way, and you do it when you start off rather than along the way. But if you're already down the track, that's no problem. I'm going to remind you that you can have a chat with Ken and his team by going to metropole.com.au and just leaving your details and saying you want to talk about wealth advisory. So I guess the tax department's going to keep looking at us, Ken. It's going to be our job to minimize the opportunities for them to find mistakes.
And it's becoming easier and easier for them to do that. That's the thing. So sample sizes can now be as big as they want. We saw a client late last year, and, they were a developer. They did the wrong thing, and the computer system matched their BAS returns with the business's income tax return and said there was a mismatch. And the computer by itself sent out the please explain letter. So
Amazing.
No human intervention at all.
And it's only going to get more so, isn't it?
Correct.
Okay, thank you so much for your time, Ken. I guess the aim of this was to just open the eyes of investors, and don't try and do your tax on your own. Don't try and save a little bit of money. That's not a plug for us, because we don't do tax returns, but get good advice. Catch up again soon, Ken. Thank you.
Thank you, Michael. Thank you out there in the audience.
I hope you got some hints from my conversation with Ken Race, and if you'd like to get Ken and his team as part of your team to help you grow your property business, why not go to metropole.com.au? I hope by now you realise we're much more than just another buyer's agent. We help our clients safely create intergenerational wealth through property by giving strategic property and wealth advice. And it all starts by putting a strategic plan together for you with regard to property. And all our clients also have a chat with Ken's team about the right ownership structures, not just for now, but for the future. So the easy way now is to buy things in your own name. But is that how you want to set things up for future intergenerational wealth? There's lots of options. We are not accountants. Well, Ken's an accountant and his team have got economics degrees, but what we do is work with your accountants. But why not allow us to help you structure your strategies for the right ownership structures, to talk are you using the most tax effective methods, see how you can legally minimize tax, talk about estate planning. So we'd love to help you outperform the markets by giving you strategic property advice. And why not get the wealth advice from Metropole Wealth Advisory as well? Please go to metropole.com.au, have a chat with our team, and let's see what your options are and how we can help you. There's quite a number of ways that we can. I'm not sure which service is right for you. Why not find out? metropole.com.au.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I want to remind you that there is no such thing as later. Take it from somebody who's been around the block a few times. There is no such thing as later. The journey to success is filled with laters. Oh, look, I'll spend more time with my kids later. I'll find time for my health later. I'll have more freedom later. I'll enjoy myself more later. The brutal reality is that later never truly comes. It's just another word for never. Think about it. Most of the things you say you'll do later may not even be possible by the time you get them. Your kids won't wait. They're going to grow up before your eyes. Your health, well, it doesn't wait either, does it? It's already ticking away whether you're paying attention to it or not. And the life you dream of, full of freedom and enjoyment, it doesn't suddenly appear. It's not a switch that you can flip when you're ready. Life doesn't hit the pause button to allow you to catch up. Time moves forward relentlessly, and if you're always putting things off for later, you'll wake up one day wondering where all those laters went. The biggest regrets don't come from things we did. I've found they come from things we never got around to doing. So here's the truth. Either start designing your life, the life you want for now, or live the regrets later. Your future self is simply the sum of all the choices you make today. So if there's something important you've been promising yourself you'll do, there's only one good time to start, and that's right now. Thank you for spending the last little while with me. I hope you got some benefit from this show. But before you move on to the next podcast you're going to listen to, let me remind you I have another show that I produce once a week with leading demographer Simon Kirstenmacher. We call that Demographics Decoded, where Simon and I unveil the trends that are going to shape your future. In my mind, this is a must-listen-to podcast for anyone interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second and subscribe on your podcast app where you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney Podcast, why not click the link that says follow or subscribe wherever you're listening right now. So twice a week, you're going to get benefit from my guests and me. Oh, and I'd like to ask you a little favour, please. If you did enjoy today's show and you know somebody who would also benefit, please tell them about the Michael Yardney Podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcast, there are 3 little buttons at the top of the player. Or just tell them about it. Just have a chat with them. Now, I hope you're going to be doing them a favour, and you're definitely going to be doing me a favour in my quest to help as many people as possible to become financially literate. And by the way, I've got a special bonus for you. As my way of saying thank you for subscribing, just go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. It's just my way of saying thank you for taking the time to listen. And remember, the information that we give you in this podcast is general information, not specific information about your personal circumstances, because we don't know about them. But if you do want specific information, you can always have a chat with my team at Metropole. Go to metropole.com.au. If you really want to learn more, you can always listen to the previous podcast, the many episodes we've already published. Just go back to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney Podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael, but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?